Hi, this is John Lux of AskLux.com and reverse-merger.info. I wanted to talk about some of the things that are kind of what we call in the law traps for the unwary. That's what we used to call them when I went to law school. They're things that, unless you're familiar with the territory, you might not realize would be problems. The first thing is finder's fees. In many states, I think in most states, if you're making an offering and you pay finder's fees to a person who's not registered as a broker in that jurisdiction, you're violating the securities laws, because most of those small offering exemptions require that no commissions be paid, or that commissions only be paid to people licensed as broker-dealers in that jurisdiction. So you want to be very careful of that. The next one also concerns finder's fees. If you are going to do a public offering, the regulators allow the broker-dealer only to have a certain amount of commission, and they will count against that commission any amounts that is paid to finder's fees to help you find the underwriter, sell the stock, or whatever. That will reduce the underwriter's commission. And having been an underwriter, I can tell you that I really do not like people coming in and reducing my commission, so they're going to be more reluctant to take your deal. The next problem is that in some states, in some offerings, the company and its principals will actually have to file as brokers. They'll have to be registered with the state for brokers before you can sell the stock. Another problem, another trap for the unwary is there's an SEC rule that not everyone knows that says if you have an asset that you bought for a low price and it's appreciated, you have to show it on your financial statements at the low price, not at the higher market value. And there was a group here that were telling me the sad tale of woe. Their accountant didn't know this rule. They got the offering all set up to go. When they filed with the SEC insisted that they had to show a very low basis on the land, because it was something they had bought years before at a very low price, instead of the appreciation price, the high price that it had at present. And that was enough to kill the deal. Another problem is you have to be wary of the securities regulations, because the regulators, quite properly, are always raising the bar. They're always getting tougher and tougher with the regulations. So not only do you have to comply with what the regulations are now, you have to comply with at least the next notch, the next tightening of the regulations. So you want to be very tight about how you comply with the securities laws. Another problem, which we mentioned on another video, is not having 2 years of audited financials and not being able to get them. There's more, of course. There's a lot more, and if you want to learn more about it, you can go to AskLux.com and reverse-merger.info, or give me an email and I'll be happy to talk to you. Just call me up. See you then. Bye.